Now, if you ask most people what they think successful investing looks like, they'll probably describe something like this. Someone glued to a screen, watching stock prices tick up and down, placing big bets on the next hot company, coming out a millionaire. Well, that's a compelling image, but it's almost entirely wrong. If you dig beneath the surface, you'll see that people who invest successfully tend to follow a completely different approach. It's not about picking winners. It's about building a diversified investment portfolio that's made up of a mix of investments that are right for you and your circumstances, and that can help you withstand the ups and downs of the market and grow your wealth over the long term. And this might sound a little less exciting, but it's a lot more effective. Hello, I'm Brian, and I'm here with Moneyfarm to explain what a successful investment portfolio actually looks like, what goes into building one, why structure matters more than stock picking, and how you can put these principles into practice whatever your level of experience. So let's dive in. Let's start with the most important concept in long-term investing, diversification. Now, you've probably heard the phrase, don't put all your eggs in one basket. In investing, that's not just a nice saying, it's the whole game. And here's why. We know that all investments come with risk. Values can go up, but they can also go down. So if you put all your money into one company, one sector, or even one country, and that part of the market has a bad year, your entire portfolio takes the hit. Well, diversification is the solution to that problem. By spreading your money across a range of different investments, you reduce the impact that any single one of them can have on your overall portfolio. If some go down, others may hold steady or go up. And that balance is what makes a portfolio resilient. So what does diversification actually look like in practice? Well, there are four main types of diversification. You can diversify across asset classes, which means owning a mix of shares, bonds, properties, commodities, and cash, where each one has a purpose, as they behave differently in different market conditions. You can diversify across regions, which means spreading investments across the UK, the US, Europe, Asia, and emerging markets, so you're never overly dependent on one single economy. And you can also diversify across sectors, which means investing across technology, healthcare, energy, finance, consumer goods, and more. So a slump in one industry doesn't sink your whole portfolio. And you can even diversify across company sizes, which means mixing large established companies with smaller, faster growing ones. But why is diversification so important? Well, the key insight is this. Not everything moves in the same direction at the same time. When technology is struggling, for example, healthcare might be thriving. And when the US economy dips, Europe might be doing better, which is why having a well-diversified portfolio can help withstand these kinds of shifts. Now, knowing that diversification matters is one thing, but actually building a portfolio, well, that's where it gets personal. Because here's the truth. The right portfolio for you is not the same as the right portfolio for someone else. And there are three things about everything else that determine what your portfolio should look like. The first one is your goals. What are you investing for? Retirement in 30 years? A house deposit in 5? Or just building long-term wealth without a specific end date in mind? Your goal shapes everything. The second one is your time horizon. How long can you realistically leave your money invested? Because this matters enormously. If you have decades ahead of you, you have time to ride out market downturns and recover from short-term losses. But if you need your money in a few years, well, a sharp market fall just before you withdraw it could be genuinely damaging. And this is because over a short time frame, the value of your investment may even fall below the amount you originally invested. In other words, if you don't have at least some years before you need the money, investing may not be the best option for you, and you might prefer to keep your savings in cash instead. The third one is your attitude to risk. How comfortable are you with your investments going up and down in value? Now, some people can watch their portfolio drop 20% and feel quite calm about it, whereas others might find that incredibly stressful. Both responses are completely valid, but they lead to different portfolio structures. But why is knowing these three things important? Well, because these three factors feed directly into what's called asset allocation, which is a decision about how much of your money to put into different types of investments and in what proportions. Because decades of well-regarded academic research, including landmark studies from the 1980s and the 2000s, have reached a striking conclusion. Asset allocation has a far greater impact on long-term investment returns than trying to pick individual winning stocks. In other words, how you divide your money between shares, bonds, and other assets matters more than which specific specific investments you choose, which means it's the structure of your portfolio, not the individual bets, that drives long-term success. Now, generally speaking, a portfolio with a higher proportion of shares carries more risk, but also more potential for growth over the long term. On the other hand, a portfolio weighted more towards bonds tends to be more stable, with lower but steadier returns. So where you sit on that spectrum depends on those three personal factors: your goals, your time horizon, and your attitude towards risk. Now, once you've decided your asset allocation, the next step is to make sure you're properly diversified across each area so you don't have too much of a concentration of anything anywhere, whether that's a sector, a country, or a company. So far, so good. But here's where a lot of people start to feel overwhelmed. Building a generally diversified portfolio by buying individual shares, bonds, and assets from markets all over the world is not a small task. It would take significant time, knowledge, and trading costs, and you still need to keep on top of it as markets evolve. Well, fortunately, there's a much simpler way. Funds. A fund bundles together a large collection of investments, sometimes hundreds or even thousands, that you can access through a single purchase. So instead of buying shares in 40 different companies one by one, you buy one fund that holds all of them, which makes diversification dramatically more accessible. When it comes to funds, there are two main types to know about. The first is actively managed mutual funds. Now here, a professional fund manager researches markets in great detail and makes active decisions about which investments to buy and which to sell, all with the aim of beating the market. In a way, it's like hiring an expert to make investment decisions on your behalf. That expertise, though, comes at a cost, as actively managed funds tend to charge higher fees than other types of funds. And this created a problem, as despite all that effort, data consistently shows that very few actively managed funds are able to beat the market reliably over the long term. Some do, of course, but most don't. And you won't know in advance which ones will. And that limitation is actually what gave rise to the second type of funds, ETFs and index funds, which take what's known as a passive approach. So rather than trying to beat the market, they simply track it, mirroring the performance of an index like the FTSE 100, the S&P 500 in the US, or a global index like the MSCI ACWI. And because there's no team of managers actively making calls, the fees are significantly lower, which means more of your money stays invested and working for you over time. Now, if you want to go deeper on how these fund types compare, including the differences between ETFs and index funds specifically, we've got this video on the channel that covers exactly that. For now, though, the key point is this: by combining a small number of funds across different asset classes and regions, you can build a properly diversified portfolio without needing to manage hundreds of individual investments yourself. But what if you don't want to choose your own funds either? What if you'd rather hand the whole thing over to someone who knows what they're doing? That's where ready-made portfolios come in. Some investment providers, including Moneyfarm, offer portfolios that are built and managed by professional investment teams. So you don't choose the individual investments. Instead, you typically answer some questions about your goals, your time horizon, and how you feel about risk. And then you're matched with a portfolio that's designed to reflect all of that. And here's where it gets even more practical. Over time, some parts of any portfolio will grow faster than others, which means the balance can gradually drift away from your original asset allocation. If shares have had a great run, they might end up making a larger slice of your portfolio than intended, which means you're taking on more risk than you planned. Bringing things back in line is called rebalancing. And if you invest yourself, this is something you need to be on top of. On the other hand, with a ready-made portfolio, everything inside the portfolio, from the fund selection to the asset allocation to the ongoing rebalancing, is handled for you. And all you need to do is invest regularly and stick with your plan. For many people, this is generally the most sensible approach. Not because it's the lazy option, but because it removes the risk of making poor decisions driven by emotion, inexperience, or simply not having enough time to keep on top of things. That said, if you do prefer to build and manage your own portfolio, just bear in mind that checking in periodically, not to react to every market move, but to make sure your investments still reflect your goals and circumstances, is a healthy habit worth keeping. So let's bring all this together. Building a successful investment portfolio isn't about picking the hottest stocks or timing the market perfectly. It comes down to a few clear principles. Diversify across different asset classes, regions, sectors, and company sizes. So no single event can derail your entire portfolio. Get your asset allocation right, so the balance between shares, bonds, and other assets reflects your goals, your time horizon, and your attitude to risk. Use funds to make diversification practical, whether that's by yourself using ETFs, index funds, or mutual funds, or by using ready-made portfolios. And then stay invested, as the biggest enemy of long-term investing isn't market volatility, it's making emotional decisions that pull you off course. So build a portfolio you can stick with, and let time do the heavy lifting. And there you have it, everything you need to know to build a successful investment portfolio. I hope you enjoyed this video, and if you did, please subscribe to the channel and have a look at the description where you'll find more on Moneyfarm and how to invest. Just to give you a quick picture, Moneyfarm brings together managed investment portfolios, cash solutions, and tax-efficient accounts like ISAs and pensions all in one app, which helps you manage your money in a simpler way, combining smart technology with guidance from investment experts. Well, that's it from me. And as always, I look forward to seeing you in the next video. Bye-bye for now.